Okay, morning. Thanks to everyone for joining us today for our webinar, Big Companies, Big Returns, Why Big is Not Always Best in the Investment World. Today, let's get to the next slide. I'm joined by Garrett Quigley. Garrett's the Managing Partner and Co-Chief Investment Officer at Global Systematic Investors, or GSI for short. So just a quick overview of what we're going to cover off today. I'll just do a bit of intro and housekeeping before handing over to Garrett, a bit of Q&A, and then finally we'll just close with a reminder of our second opinion service. The webinar is expected to take no longer than 30 minutes, including the questions. We'd love to answer any questions you've got. Use the chat box, probably down at the bottom or on the side, wherever it is, if you want to ask any as we go through. It's amazing having a fund manager on this call. It's a really good opportunity. So please do ask away if there is anything you want to cover. And this webinar is being recorded. So the plan is to send a link across afterwards. If you wanted to pass it on to friends, colleagues, family, or even if you wanted to watch it again, if it was that good, that would be great. So GSI, we first met GSI about 2.5 years ago now, and the reason for that was we were trying to improve the sustainability overlay within our investment strategy. So since Ifamax started back in 2003, we've always followed an evidence-based investment strategy, which for any of our clients on the call you'll know all about. But what we've also always been trying to do is to improve on the sustainability overlay that we've applied to that evidence-based strategy, which has always been really tricky for us to do. It was back in the summer of 2017, we were using the only fund in the market that was doing sustainability and evidence-based, but we weren't really happy with what that fund was doing and sort of the direction it was heading, which is why we set about trying to find a new fund that we could use. So to cut a long story short, we eventually met with Garrett and the team at GSI, who were running an evidence-based fund back then, which didn't have a sustainability overlay. So Garrett and the team there did a lot of research into that area, and they agreed that they'd change their existing fund to also incorporate the sustainability overlay, which was great. So the fund management industry has been very, very slow to sort of kind of get on board with this. And for us as advisors, we see a lot of interest, and we have seen a lot of interest over it for the last few years from our existing clients. So it's great that it's kind of slowly starting to move. And in the last 18 months to a year, we've definitely seen more and more funds launch in this space, which is great because we can potentially be bringing them into our investment strategy. So just a quick reminder for anyone who doesn't know, or for any of our clients on the call that are maybe forgotten, ESG stands for Environmental, Social and Governance. And it's a set of non-financial criteria that socially conscious investors can use to screen investments. Okay, so that's how we know GSI. We've been using their fund for the last 18 months or so in our strategy. So without further ado, I'm going to pass you across to Garrett. I've been doing a lot of webinars and Zoom meetings over lockdown, as I'm sure most people have. And I definitely think that the number of guitars in the background of people's settings is definitely a measure of how big someone's ego is. So congratulations, Garrett, you've passed the ego test today. So over to you.
Well, I won't pan left then, because then that would shatter that illusion. So thanks for the introduction, Ashton, and for the opportunity to speak with your clients. So what we're going to talk about today is that recently some large companies, particularly in the US technology sector, for example, have garnered a lot of attention.
Sorry.
Excuse me?
You need to start sharing your screen because it's still on mine, I think.
Oh, I see, yeah. Sorry, bear with me. How's that? Can you see my screen?
Yeah, Sorry, I couldn't find the unmute button. It's all good. Well done.
Okay, good. So what we wanted to talk about was the fact that some companies have recently been kind of dominating the headlines in stock market, and some people refer to these as like the FANG stocks, but it's so-called Facebook, Apple, Amazon, Alphabet is Google, so Google's the search engine. And what we wanted to do is to sort of place that in context and look at the wider perspective, both of stock market returns in general, what drives stock market returns and what influences them, and then what we might think about the expected returns of these kinds of stocks based upon our experience in the past. So what we want to do then is before looking at the way that those large set of companies changes over time, let's look first of all at the way that overall factors influence stock returns. And so in this chart, we're looking at global developed markets over a long time frame. And on the top row, we've got the United States. On the bottom, that's the top graph up here. And then on the bottom graph here, we've got non-US developed markets. And the chart is showing a column for a 10-year period. The reason it's good to use a 10-year period is because it smooths the returns, the ups and downs for each year. And so when we're looking at 1936 here, that is showing the annualized return for a 10-year period ending in 1936. So 27 to 36. And then we're looking at the rolling 10-year returns across time. And this is in dollars. And the source of this is an American financial economist called Ken French, whose name is at the bottom there, who's at Tuck Business School in Dartmouth, who's a world-renowned financial economist and works very closely with Gene Fama, Professor Gene Fama, who was awarded a Nobel Prize in 2014. And so Fama and French are extremely well-known and influential pair of academics who do a great service to us by putting out these returns and making them available to everybody so that we can see what these look like over long time periods. So what's interesting about this graph is that you can see that on average the 10-year return is positive, and it's handily positive. It's about on average about 10% per annum on average over these 10-year periods. But there are periods when you have negative returns even over a 10-year period. And so here you're looking at the recession in the 30s, the depression in the US. Here you're looking at a recession in the early 70s when you had, for example, the US came out of the Bretton Woods Agreement, you had various currency crises, you had the oil crisis brought on by OPEC. That had a very serious impact on global markets in the mid-70s. Then you had a very long period all the way through, say, the Reagan-Clinton era, where you had very high, strong returns across US markets. And the next time markets really got tested was in the global financial crisis, which you can see here terminating in 2018. That's like close to the trough of the financial crisis. Subsequent to that, you've had general recovery, largely assisted by central banks and a lot of financial policy, including quantitative easing, etc. We end in 2019, and we'll talk a little bit maybe about what happened afterwards, but this chart does end at the end of 10 years in 2019. We also look, at developed markets, non-US, on the chart below, and again you see some cycles where it's done better than others, but overall you find a strong positive equity premium, Okay, so that's the equity returns that you're getting. And this is just the absolute return that you're seeing over an annualized returns over close to, not far off 100 years in the US, and since 1975 in non-US developed markets. So, so that's the overall stock market. However, what Fama and French are renowned for is their demonstration of the fact that there are additional factors that influence stock returns. A key one is the difference between the returns of large versus small cap stocks. What they show is that over time, there's what's called a small cap premium, which is an extra return that investors obtain by investing in smaller cap stocks versus large cap stocks. And so this is the small cap premium, or the size effect, other people call it. And what we see on the top chart here are returns of a small cap portfolio versus a large cap portfolio, small minus big. And over 10 years, for example, terminating in 1936, an investor had a premium of around 6% from investing in small cap stocks versus big stocks. We track that premium through time. And again, you see that overall, most of these bars are in blue, but there are some periods you have a sustained negative outcome or negative relative return by investing in small cap stocks versus large. And so here, for example, was over the 60s. This was the so-called Nifty 50 stock period when primarily large cap growth stocks dominated in the US. Then we had quite a long period up through the 80s when small cap stocks did better. In the 90s, we see that large cap stocks, also large cap growth stocks, did somewhat better. And again, then we flipped over again. And in fact, it's only recently that small cap stocks have underperformed large cap in the US market. We also have data on this for non-US developed markets. And so this is actually based on, again, on Ken French's data, but it's driven from Bloomberg, is the underlying source. And the start date for this is 91, and so the first 10-year period ends in 2000. And somewhat similar to what you see in the US, you had a negative relative return for size. But after a few years, small cap stocks have been doing better. And in fact, for most of the last decade, small cap stocks have done better than large in non-US markets. And so the two numbers over here refer to, again, the longer histories. In the US, we've seen an annualized premium of around 2% and a bit for small cap stocks versus large cap, and just a bit under 1% in non-US markets. Moving to value minus growth. So another key factor that Fama and French showed us is the difference in returns between value stocks versus growth stocks. And what this means is that value stocks typically refers to stocks that are trading at a low price relative to their fundamentals. Stocks that are trading cheap, or stocks that are trading possibly at somewhat distressed levels, but more generally it's just stocks that are trading at somewhat low prices versus stocks that are trading at high prices. So, so this is called the value effect. And you can see that, again, looking at the long run history in the US stock market, there's been a substantial premium over the long haul of investing in value stocks versus growth stocks. For a very extended period of time, there was a premium to doing that. However, I'm sure many of you are aware of the tech bubble that happened in the late 90s in the US, and that's shown here in this negative couple of bars, where the 10-year premium was actually negative for a short period. More recently, in the US in particular, there have been negative returns to the value premium. This is widely discussed and shown that growth stocks have been doing better than large cap stocks. But that's something of an exception relative to the long run history. And so we should bear in mind that whilst there are sustained periods when value can underperform growth, the expectation is that in the long run, you get a premium from investing in value stocks. And a further point is that, in fact, value stocks are trading now at a level that is as cheap relative to growth stocks as we saw in the around the tech. Not quite as extreme, but not far off. So moving to, I'm going to pass on this one. Pharma French have identified other metrics, including profitability, where they show that stocks trading at that demonstrate a higher profitability versus stocks that do not also tend to deliver excess returns. But that's not our focus today. What I'd like to focus on now for the next few minutes is looking at the top 10 stocks and how the top 10 stocks change over time. And we're going to take this back to 1980 and look at the top 10 stocks per decade from 1980 up until 2020. And when we look at the top decade, the decade in 1980, the chart shows the top 10 companies across global markets. It so happens at this time all these companies were American. And we can see that the top of the list there is IBM, world famous company, famous for its computers. At the time, it was famous for mainframes, and then it developed the personal computer and dominated that space for many years. The next one is AT&T, which is an American telecoms company, still around today, one of the top 2 telecoms companies in the US. Exxon, which is a US energy company. And in fact, there's a whole bunch of companies here that are energy related. And so in the 1980s, reflecting the dominance of energy and oil in the US market in particular, but globally, it's not surprising to see so many of these companies dominating the leaderboard, as they call it, across markets. Now, if we look to the next decade, we see that things have changed a lot. And a lot of these companies have actually not made it into the subsequent decade. They're there, they're just at lower rankings. The top ranked companies that we're showing here. We can see that IBM went from being top placed to being 7th placed. Exxon moved to 4th place, and AT&T became the 9th placed. And then General Electric moved up. Notably, in 1990, across the world, more than half of the largest companies were actually Japanese, because this was an era when Japan had been booming as an economy and had grown to be very large and were extremely successful, exporting a lot. I'm sure some of you remember the dominance of Japan in those days. And so they had displaced a lot of these American companies as the leaders across the world. What's interesting, however, is that one decade later, a lot of these companies were now no longer so big. And so we now have a lot of changes in that top list. Nippon moved to 4th place. Nippon actually split into, or it spun off NTT Docomo, which is the mobile group of Nippon Telegraph. And other than that, no other Japanese companies are now in the top 10. 2000 was close to the peak of the technology boom, so it's not surprising to see a new entrant there at the top of the board, which is Microsoft. And Microsoft had done extremely well because it provided the operating system, the operating software for personal computers. And by virtue of doing that, it had just a huge market across the entire personal computer industry, at least the IBM computers. And so that led to Microsoft's dominance for a period of time. And in fact, Microsoft is still one of the top companies in the States. Other entrants that have come in was Walmart now, which is a US retail company. there are other companies which are technology or telecom companies, and you can see Citigroup down here. Of the companies in 1990, we can see that only NTT, which has these two components, Exxon, which is now much lower ranking, and IBM are the only survivors from the previous decade. Looking across then to the next decade, we can see that there have been yet more changes. One company that now switches to the top of the group is Exxon. Excuse me, but in fact, Exxon only got there because it merged with Mobil just beforehand. If it hadn't merged with Mobil, it would have fallen off the list. But by virtue of merging, Exxon now became one of the biggest stocks. We can see that Microsoft now has moved to 2, and few other companies have made it across into the top 10. Walmart's still there, BP, British Petroleum, is there, but all the other companies have dropped off. Finally, when we look to 2020, we can see that the top 5 companies here are now all technology companies. Relatively few technology companies were in 2010. And indeed, you'll remember that this was just after the global financial crisis. And so typically these are kind of older economy type companies that were dominating at that time. Now that we've had quantitative easing and we've had a decade of shifting towards social media, personal computing devices, handheld phones, and the general dominance of search engines. Google, for example, is the company that's associated with Alphabet. We can see that these core companies, the so-called FANG stocks, are now dominating the leading group in the States. Having said that, besides that, the remaining companies are kind of older economy companies. Berkshire Hathaway, which is Warren Buffett's company, JP Morgan Chase, which is a US bank, Visa, we all know as the payments company, Johnson & Johnson Health, and Walmart again, the healthcare company, or sorry, the retail company. So we see again by 2020, there's been a major shift in the nature of the companies and a new dominance of technology in the leaderboard here. What might we expect going forward, and how have these top 10 companies done over time? So you might be surprised to know that, in fact, if you look at the annualized returns of the top 10 companies versus a broad sample of the top 2,000 companies across global markets, global developed markets, what you find is that the top 10 companies returned around 9% a year, and the top 2,000 companies, market weighted, rebalanced every year, returned 11.9%. And so the difference is about 2.9% per annum for that 40-year period. So despite these companies being very successful, being leaders in their field, and being dominant in the stock markets in their era, their returns, once they get into that top 10, are actually substantially less than the returns of the average company in the stock market. And the cumulative effect of that is shown in this chart. So if you had invested £1, and this is shown in sterling, if you had invested £1 in the top 10 companies and rebalanced each year into the top 10 companies, held it for a year, and so on throughout the decades, you would have had a return of about £30 if you'd held on to that for that until 2019. However, if you had invested in the top 2,000 companies in proportion to their market weights and rebalanced again each year, you would in fact have ended up with a cumulative return of around £90. Now, you know, that's a particular extreme portfolio that you would have chosen. I don't think anyone would recommend that you invest in the top 10 stocks like this, but it is nonetheless instructive that despite the success of these companies as companies, that doesn't necessarily mean that as investments they're going to be so good compared to smaller companies and value companies. And so the message we take from this is that, in fact, we prefer to underweight mega cap companies, the biggest companies in the market, because they're associated with lower returns going forward. And we believe that you're better off tilting towards smaller companies and value companies because, as Fama French and others have shown, there's an additional return that you pick up by investing in those companies. So I think I'm going to stop there and hand back to Ashton. And if you have any questions, please, please let me know.
Thanks, Garrett. Yeah, good. So question-wise, there doesn't seem to be anything in the chat at the moment, but if anyone does have anything, please feel free. There is one question I've got that come to mind watching that was, obviously all your data seems to be to the end of 2019, and given what's happened so far in 2020, have you seen much change in sort of like the top 10 holdings and how they've fared so far this year?
So a key, you know, the key event obviously in 2020 so far has been the coronavirus and its impact on the economy, and that clearly led to an immediate fall in stock markets, quite a sharp one, as we all know, globally, which was then immediately counteracted by efforts by central banks to stimulate economies and to support asset prices. So there's been a significant continuation of quantitative easing, in fact, an increase of it, a reduction in interest rates, and an extreme efforts to support the economy, as we've seen with you know, government steps in the UK. So that's unprecedented. In terms of the impact on the market since then, the market's actually recovered very significantly from that trough that it was in, and so the stock market is now actually riding fairly high, at least for now, relative to where it was just at the end of March. In terms of where this list is, most of the companies that are still there, we continue to see a preference for growth in the economy. Partly that's related to the fact that quantitative easing is leading to a preference for growth, likes of Apple, Microsoft, etc. And people are willing to tolerate the fact that, say, Amazon is investing incredible amounts to increase its market share, even though relative to other companies, it actually doesn't make so much money. Another example would be Tesla, for example, which has just overtaken Toyota as the largest car company by market cap, despite the fact that it makes much less money relative to other car companies and has much less experience historically of building cars. So there are definitely, there's a continuation, I would say, of themes that have been apparent over the last 3 or 4 years. Mega cap companies continue to do better for the moment. Growth continues to do better. However, that's been largely supported by quantitative easing and government policies. I did see a question about the weight of the top 10 companies, and currently those top 10 companies is something around 15%, and that is certainly higher than it has been for the last 10 or 20 years. However, if you go back to 1980, the the companies that I had on that list, in fact, were more than 20% of global markets. And if you go back even further, there were periods when the market was even more concentrated. So we've been in periods when the market's been very concentrated. That's actually not so unusual. And so what we see today is certainly higher than it's recently been, but not so different than it was, say, 50 years ago.
Yeah. There was another question, I don't know if you've noticed it, Garrett, was all the data came from the same source. Do other sources agree with this analysis?
Absolutely. If you'll see, for example, that in terms of financial economics, there's very widespread agreement across financial economists that these factors dominate stock markets. And so the Ifama-French model has become the standard model for asset pricing across global markets. And so the question isn't whether there's a value effect or whether there's a size effect, which are kind of universally acknowledged. What economists tend to debate over is why that is, why that should be, and are there other things that are also impacting markets across the world. So that tends to be what people debate, not the data, not the facts that there's a size premium and a value premium.
Yeah. Okay. Great. So I'll let you go, Garrett. But thank you very much for your time.
Thank you.
This morning. Really appreciate it. And if anyone does have any other questions for Garrett, you can send them in through us, and we'll pass them on. I'm sure he'd enjoy answering them for you. Okay, so just finally, what I wanted to just finish with was just a reminder of something we call our second opinion services, which is something that we feel separates us apart from other advisors in the market. So this is something that we offer to friends and family of our existing clients, and it's on our website as well. And it's basically just trying to explain, someone might have an investment strategy already, they might have their pensions all set up, but they're not 100% sure whether it's set up in the right way. Should they be doing something a bit different? So we offer the second opinion service, and we'll take them through our process. And if we figure out that everything's fine and nothing needs to be changed, then we'll obviously tell them that. But often we find things that they could be doing better and could be tweaking, and we kind of explain what that might be. So the first meeting that we have with clients is a discovery meeting. As the name suggests, it's just a chance for us to find out more about potential clients and for them to find out more about us as well. We don't charge for that meeting, and there's no obligation to take things any further. In terms of typical advisors, most advisors will do that meeting at their expense. The difference is that most will expect they'll charge you something if you want to take things to the next level, basically. That next level is typically an investment plan meeting, that's what we call it. And that's really a chance for us to show a client, this is what we think you should be doing with your money, any changes that we think they could be making, explaining a bit more about our investment strategy. And again, we don't charge for that meeting. And again, no obligation. If you want to walk away after that, that's absolutely fine by us. Most advisors out there would absolutely charge to be putting all that work together for you. And then finally, our mutual commitment meeting is a chance for clients to come back. We've given them a lot of information. They've digested that, and they might have quite a lot of questions to ask us, and they might want us to explain things in a bit more detail, which is what we do at that meeting. And if everyone's happy and they want to proceed, then we get all the paperwork going and get things set up for them. And again, we don't charge for that meeting, and there's no initial or implementation fees to come on board as a client. We only charge clients whilst they're happy and on board, whereas most advisors in the industry would typically charge an implementation fee to get things set up for you. So I just thought that would be a good reminder for people on the call that maybe are already clients, and also for anyone who's not, to give them an idea a bit more about what we do. This is all on our website. If anyone wants to take us up on this, ifamax.com, all our contact details are there. And There's more information on the second opinion service. The only other thing I wanted to say was this is the second webinar we've done. We really enjoy putting them together and running through them, but we'd just love some feedback from anyone who's watching, good or bad. We can handle the bad feedback, honestly. So any feedback or any topics you want us to cover, anyone you'd like us to try and get on as a kind of a guest, we'd love to hear from you. So any feedback you could give us would be really, really great. And I'm just going to check because there's the chat box is flashing up just to, is that slide available to print? Oh, answered, thank you. Okay, fine. Yeah, we can send it through to you afterwards as well if you wanted it to. Oh, I nearly forgot, I'd nearly get told off by compliance here. Last slide is our compliance slide. So none of what we've said today is advice. It shouldn't be taken as advice. As you know, past performance is not necessarily a guide to the future. So we have to tell you this. But thank you so much to everyone for joining us. We really, really appreciate your time. And like I said, any queries or anything, just feed it through to us after the call. Cheers and have a good day.